Kyrie eleison.
Hello, and welcome back to the Catholic Workers Podcast. We're happy to have you join us. Today, we turn our gaze to a perhaps less visible yet profoundly influential aspect of our common life, our financial system. Specifically, we'll delve into the concept of public and municipal banks, institutions that represent a fundamentally different approach to finance, one that prioritizes public interest and community well being over private profit. For centuries, the role of money in finance has been a subject of intense moral and economic debate, deeply impacting the lives of ordinary people. The question of who controls capital, how it's allocated, and for whose benefit lies at the heart of many societal challenges. As Catholics, we're called to examine all systems through the lens of justice, solidarity, and the common good. Our journey today will unpack this vital topic in three comprehensive parts. First, we will establish a clear understanding of what public and municipal banks are, highlighting their core principles and how they fundamentally differ from their private counterparts. Second, we'll undertake a deep dive into the Catholic Church's perspective on banking and finance, tracing the evolution of its moral teachings from ancient prohibitions on usury to modern calls for an ethical financial system that serves humanity and creation. Finally, we'll explore the rich history of public banking in the United States and across the world, examining both past and present efforts and conducting a thorough cost benefit analysis of their potential to transform our communities and economies. To begin our exploration, let's clearly define what we mean by public or municipal banks. At their core, these are financial institutions owned and controlled by a federal, state, or local government entity. This fundamental difference in ownership dictates a radical divergence in their operational philosophy and ultimate purpose when compared to the private banks we typically encounter. Unlike private banks, which are primarily driven by the imperative of shareholder benefit and profit maximization, public banks operate on a distinct set of economic principles that fundamentally prioritize public interest and community well being. Where private banks must deliver ever increasing returns to their investors, public banks are directly accountable to the citizens they serve. Their success is not measured by quarterly earnings report or stock valuations, but by their demonstrable impact on local economic stability, social equity, and environmental sustainability. This inherent accountability stems directly from their ownership structure. Because they're owned by the people through their elected governments, their mandate is to serve the people. A key economic principle that underpins the public banking model is its inherent ability to keep public money invested locally. This is a critical distinction. In a conventional private banking system, public funds, such as tax revenues, fees, or other governmental deposits, are typically held in private banks. These private institutions then lend out these funds, and the profits generated from these loans, along with the interest earned, flow back to the private bank and its shareholders, often located far from the community from which the original funds were drawn. This process represents a continuous capital leakage from local economies as wealth generated from public resources is siphoned off to external private interests. Public banks, by contrast, ensure that banking profits and interests circulate within the very communities that generated the public funds. When a public bank lends money, for example, for affordable housing, local infrastructure, or small business development, the interest paid on those loans returns to the public bank. This profit can then be reinvested into the further local projects, used to reduce the cost of borrowing from the municipality, or even return to the general fund of the owning government, effectively expanding municipal revenue without necessitating an increase in taxes. This creates a powerful positive feedback loop. Public money supports local initiatives, generates profits, and that profit is then recirculated within the local economy, supporting its growth and prosperity rather than being extracted. The operational model of a public bank is therefore oriented around public benefit rather than private gain. Their lending decisions are guided by public policy objectives such as promoting affordable housing, fostering sustainable economic development, supporting small and medium sized enterprises, or investing in green infrastructure. This is a stark contrast to private banks, whose lending decisions are primarily dictated by risk adjusted returns and the potential for maximizing profit, often leading to underinvestment in areas deemed less lucrative, even if they're essential for community flourishing. Furthermore, public banks foster a unique kind of democratic accountability in finance. Because they're directly tied to government bodies, their operations are subject to public scrutiny, legislative oversight, and democratic processes. This means that citizens and their representatives have a direct say in how public money is managed and invested, ensuring that financial decisions align with the expressed needs and priorities of the community. This level of transparency and direct control over financial resources is largely absent in the private banking sector, where decisions are often made by corporate boards and executives with primary fiduciary duties to shareholders, not the broader public. In essence, public banking represents an attempt to reclaim the democratic power of finance, making it a tool for societal improvement rather than merely a mechanism for wealth accumulation. Having established what public banks are, we now turn to a critical examination of how these institutions align with the long and evolving moral tradition of the Catholic Church concerning banking, money, and finance. This tradition offers a profound critique of financial systems that prioritize profit over people and provides a robust framework for ethical economic behavior. The Church's engagement with finance has deep roots, beginning with a strict prohibition on usury, which referred to the charging of interest on loans. This condemnation was not arbitrary. It stemmed from a foundational concern for justice, compassion, and the common good, and it drew both heavily on the Old and New Testaments. Biblical texts unequivocally warn against charging interest, especially to the poor. Exodus chapter 22, verse 24 states, quote, "If you lend money to any of my people, to anyone poor among you, you will not play the usurer with him. You will not demand interest from him." End quote. Similarly, Deuteronomy chapter 23, verses 20 and 21 differentiates between lending to a foreigner, where interest was permissible, and lending to a brother Israelite, where it is forbidden, emphasizing communal solidarity. The prophet Ezekiel even lists charging usury among the sins worthy of death. In the New Testament, in Luke chapter 6, verses 34 and 35, he challenges believers to a radical generosity, saying, quote, if you lend to those from whom you hope to get money back, what credit can you expect? Even sinners lend to sinners to get back the same amount. Instead, love your enemies and do good to them, and lend without any hope of return. You will have a great reward, and you will be children of the Most High, for he himself is kind to the ungrateful and the wicked. End quote. These passages emphasize compassion for the poor and the idea of lending as an act of charity without expectation of financial return. In an agrarian society where loans were often sought out of dire necessity, for example, for food during a famine or to survive a bad harvest, charging interest was seen as exploiting vulnerability and perpetuating poverty. Early church fathers echoed these condemnations with profound moral gravity. St. Jerome, for instance, was among those who equated usury with murder, not in the literal sense, but in its destructive effect on the borrower's life and dignity. It was seen as slowly consuming the life or the blood of the debtor, leaving them destitute. St. Thomas Aquinas significantly shaped the theological and philosophical understandings of usury. In his Summa Theologiae, Aquinas argues that money, by its nature, is consumed in its use, meaning when you use money, it ceases to exist in its original form. For example, when you buy bread, the money is exchanged for bread. Therefore, charging for its use in interest was akin to charging for something that didn't exist anymore, or selling something twice. He considered usury unjust because it sold time, which belongs to God alone, or charged for the mere use of money itself, which was not considered a productive good in the way that land, tools, or a productive animal, like a cow that produces milk, were. For Aquinas, money was a medium of exchange, not a source of intrinsic growth or productivity on its own. To extract a charge for its mere use was to demand something for nothing, an unjust gain. This condemnation of usury was not merely academic. It was codified in canon law. The Third Lateran Council in 1179, for example, issued strong condemnations of notorious usurers and demand that they make restitution for their ill-gotten gains, forbidding them from Christian burial. Subsequent councils and papal pronouncements reinforced these prohibitions for centuries, reflecting a consistent moral stance against what was perceived as an exploitative practice that undermined social justice and charity. Over centuries, as economies evolved from primarily agrarian to more mercantile and industrial, the church's understanding of interest also gradually developed. This is not a capitulation of capitalism, but a nuanced adaptation to new economic realities, distinguishing between what remained usury, exploitative and unjust interest, and what constituted legitimate interest or just compensation for the use of capital. The crucial distinction became clear. Interest could be justified when it reflected legitimate compensation for several key factors. First, for risk, the inherent risk undertaken by the lender that the borrower might default on the loan. Second, the opportunity cost, the profit or gain the lender foregoes by lending the money instead of investing it elsewhere in a productive venture. This acknowledged that money in a complex economy could indeed be a productive good when invested, unlike Aquinas' earlier, simpler view. Third, for administrative costs, the legitimate expenses associated with making and managing loans, such as processing fees, legal costs, and overhead. And fourth, finally, for inflation, the erosion of the principal's value over time due to inflation, which means the repayment of the same nominal amount later represents less real value. This evolution meant that not all interest was condemned, but only that which was exploitative, excessive, or charged out of greed and without a just cause. The Church's teaching maintained its core commitment to justice and the protection of the vulnerable, but it recognized the legitimate role of financial capital in a developing economy, provided that it remained a servant to human flourishing and not an end of itself. This ethical framework has continued to inform modern papal teaching on economics and finance, especially in the wake of the global financial crises. Pope Benedict XVI's 2009 encyclical Caritas in Veritate, released in the immediate aftermath of the 2007 and 2008 global financial crisis, offered a powerful critique of contemporary financial practices. It specifically denounced the speculative use of financial resources and the tendency for finance to become an end in itself, detached from the real economy and human needs. Pope Benedict called for a profound shift towards a more ethically informed financial system that prioritizes human well being and the common good over short term profit maximization. He famously stated that there is no neutral banking. Every financial decision and system operates within a moral framework, either contributing to or detracting from justice and human dignity. This means that even seemingly technical financial operations have ethical implications and must be judged by their impact on people, especially the poor and marginalized. Caritas and Veritate emphasize the need for new forms of financial activity like microcredit and ethical investment funds that explicitly integrate social responsibility. Pope Francis's 2015 encyclical Laudato Si, while primarily focused on integral ecology, extends its critique to the economic systems that drive environmental degradation and social inequality. Francis denounces the absolute power of a financial system that has no future and will only give rise to new crises because it's divorced from real human needs and the ecological limits of the planet. He passionately calls for finance to be fundamentally understood as a form of service, an instrument to serve people and care for our common home, rather than merely a tool for speculation and insatiable profit. Laudato Si strongly supports socially responsible investing decisions that are explicitly aligned with values like protecting human life, promoting human dignity, enhancing the common good, advancing economic justice, and fostering environmental stewardship. This means that financial institutions, and indeed all financial actors, have a moral obligation to consider the social and environmental impacts of their investments, moving away from purely profit driven motives. These modern encyclicals consistently call for a financial system that embodies core Catholic social teaching principles, like subsidiarity. Financial systems should empower individuals and local communities, enabling decision making and control to remain as close to the people as possible, rather than concentrating power in distant, centralized institutions. Public banks, by their local ownership and accountability, inherently reflect this principle. Solidarity. Financial institutions should foster a sense of interconnectedness and mutual support, recognizing that we are all part of one human family. This means prioritizing the needs of the vulnerable and ensuring that financial resources are used to build up the entire community and not just a privileged few. Public banks, by their very nature, promote solidarity by directing resources to where they're most needed for community flourishing. The universal destination of goods. This principle affirms that the goods of the earth are intended for the benefit of all humanity. Consequently, private property and wealth are not absolute rights, but come with social responsibilities. Those who control financial resources, whether private individuals or public institutions, have a profound moral obligation to use them justly and for the benefit of all, ensuring that access to capital serves the common good. Public banks, by design, are structured to fulfill this social responsibility, directing wealth towards the needs of the many rather than the profits of the few. In summary, the Catholic Church's long-standing moral tradition on finance provides a compelling argument for financial systems that are ethically grounded, publicly accountable, and oriented towards human dignity and the common good. Public banking, with its emphasis on local investment, community well-being, and democratic oversight, presents a model that aligns remarkably well with these enduring principles. Having explored the ethical imperative for a just financial system, let's now turn to the practical realities and historical precedents of public banking. We'll examine its fascinating, if often overlooked, history in the United States, survey modern efforts to establish new public banks, and look at successful examples from around the world. Finally, we'll conclude with a clear cost benefit analysis of this transformative model. The origins of American banking are far more intertwined with the public sector than many realize. While private banks became dominant later, the very first stirrings of organized finance in the colonies were deeply rooted in public initiatives. As early as 1729, colonial governments, influenced by visionary figures like Benjamin Franklin, began establishing loan offices or land banks. These institutions were explicitly designed to serve public interest by providing accessible credit, primarily in the form of mortgages for small farmers, at uniform and remarkably affordable interest rates. Franklin, in his modest inquiry into the nature and necessity of a paper currency, argued that such public banks could facilitate economic growth by providing a stable and available currency, fostering industry, and supporting honest labor. A significant and innovative feature of this colonial system was the utilization of interest income from these public loans as a crucial source of government funding. This revenue helped cover essential public expenses, reduce the tax burden on citizens, and directly supported vital public services such as poor relief and the nascent system of public schools. This early period demonstrates a clear historical precedent for public finance serving direct public benefit and not private profit. Following the expiration of the Second Bank of the United States' charter in 1836, the nation entered a tumultuous period of free banking, characterized by a proliferation of state chartered banks with often lax regulation. Yet, even within this chaotic period, numerous states actively sought to establish and maintain their own financial institutions rooted in public ownership. Large number of states boldly created banks fully owned by their respective state governments. These were not merely passive investors, these were direct public enterprises intended to serve state level development goals. Other states maintained majority interest in banks, giving them substantial control over lending policies. For example, Louisiana took a unique path, chartering private institutions but explicitly compelling them to pursue public policy objectives, such as financing the crucial construction of railroads and canals, laying the groundwork for vital infrastructure projects that private finance alone would not prioritize. This period, though short lived, illustrates a vibrant, if ultimately unsuccessful, experimentation with diverse forms of public finance at the state level. However, this flourishing period of state led public banking was largely short lived and faced immense challenges. The devastating financial panic of 1837, a severe economic depression that saw widespread bank failures, commodity price crashes, and mass unemployment, dealt a crushing blow to many of these nascent public banks. Compounded by other economic challenges and sometimes political mismanagement, most of these state owned banks struggled and ultimately closed their doors by 1900. The National Banking Acts of 1863 and 1864 further reshaped the landscape, intentionally establishing a new national banking system dominated by privately owned banks that could issue notes backed by treasury bonds, creating a more uniform but entirely private currency. In 1865, Congress enacted additional measures, including a prohibitive tax on state bank notes, which effectively suffocated the remaining public and independent state chartered banks and definitively ushered in an era dominated by federally chartered private banks, laying the foundation for the financial system we recognize today. This shift systematically marginalized the public banking model in the United States. Amidst this historical backdrop, one extraordinary institution stands as a testament to the enduring viability of public banking: the Bank of North Dakota, BND. Established in 1919, it remains the sole active state owned bank in the United States. Its creation was a direct and forceful response to the severe market failures in North Dakota's agriculture driven economy during the early 20th century. Farmers were exploited by out of state banks and powerful grain monopolies, forcing exorbitant interest rates and predatory practices. The populist nonpartisan league, driven by the needs of these struggling farmers, successfully pushed for the bank's establishment, envisioning it as a public utility to serve the state's economic interests. The BND operates under a unique governance structure, managed and controlled by an industrial commission comprising the state governor, the agriculture commissioner, and the attorney general, ensuring direct accountability to elected officials. An advisory board consisting of 7 private banking officers appointed by the governor provides valuable additional oversight and expertise, bridging the public and private sectors. A cornerstone of the BND's success is its legal mandate. All state funds, including those from penal and educational institutions, are legally required to be deposited in the BND. This provides a stable, low cost capital base that private banks typically do not have. The bank primarily functions as a banker's bank, a crucial distinction. It does not typically compete with local private banks for retail deposits or directly engage in consumer lending on a widespread basis. Instead, it forms powerful partnerships with local banks and credit unions across North Dakota. The BND leverages its public resources to provide liquidity, participate in loans, and guarantee portions of loans made by these local institutions, effectively expanding their lending capacities in areas aligned with BND's mission, which is to serve the state's economic development. This symbiotic relationship strengthens local financial institutions rather than undermining them. The only direct loans BND typically makes to individuals are for student loans, a vital public service ensuring access to education, and some home mortgages in the most rural parts of the state where private lending might be scarce. Its loan portfolio reflects its public mission with a heavy concentration in commercial and agricultural loans, constituting approximately 2/3 of its substantial $4.7 billion portfolio. Student loans make up about a quarter, highlighting its role in human capital development. The Bank of North Dakota has demonstrated an astonishing century of stable operating performance, consistently generating profits that benefit the state. In 2023, it reported a record net income of $192 million, achieving an impressive 18.2% return on investment. This profitability is not extracted from the community but returned to it. The bank consistently transfers a portion of its profits to the state general fund, contributing millions of dollars annually that can be used for infrastructure, education, or to reduce taxes. Furthermore, the bank maintains very strong capital ratios and robust loan loss reserves, ensuring its stability and reliability. Its sound financial health is affirmed by leading rating agencies, with S&P affirming BND's credit rating as A+ or stable, a rating often higher than that of major private banks, underscoring its fiscal prudence and unique public mandate. The BND stands as a compelling, living proof that a public bank can be both fiscally responsible and profoundly beneficial to its community. Inspired by the enduring success of the Bank of North Dakota and fueled by a renewed desire for local financial control, there's a growing movement for public banking across the United States. California, for instance, passed Assembly Bill 857 in 2019, a landmark law that empowers cities, counties, and regions to form their own public banks. This legislation opened the door for a paradigm shift in how local governments manage and invest their financial resources. Following this, major cities like Los Angeles and San Francisco are actively developing concrete proposals for municipal public banks. Los Angeles has moved forward with funding a feasibility study and business plan for its public bank, aiming to transform the city's affordable housing landscape, accelerate clean energy infrastructure development, and support financial justice initiatives to combat predatory lending. San Francisco, in July of 2023, accepted a plan to create what may become the first municipally owned bank in the country, with similarly ambitious objectives to finance the construction of critically needed low-income housing, fund climate change initiatives such as renewable energy projects and climate resilience infrastructure, and provide crucial support for small businesses that often struggle to access capital from traditional lenders. These efforts represent a tangible commitment by cities to leverage their collective financial power for the direct benefit of their residents and long-term development goals. Beyond the United States, public banking models are widespread and highly successful, often forming the backbone of national and local economies. Germany provides a robust example of a highly successful public banking sector. The contemporary German public banking sector primarily comprises two main clusters: the Sparkassen Finance Group, a vast network of local savings banks and their regional counterparts, the Landesbanken, and Förderbanken, promotional and development banks. The Sparkassen model is particularly noteworthy. These institutions, established by law, operate with an explicit mandate of public service and regional development. Unlike private banks, their success is measured not solely by traditional economic requirements like profit margins, but by their demonstrable impact on local communities, such as their contribution to job creation, local investment, and social cohesion. They operate under a strict regional principle, meaning each savings bank is independent, locally managed, and focuses its business activities exclusively on customers within its specific geographical area. This ensures that their lending is deeply rooted in local needs and priorities. Sparkassen are generally not profit-oriented in the traditional sense. Any financial surplus is typically retained or reinvested directly into their local communities or allocated to public welfare projects. This model has proven incredibly resilient and effective. Sparkassen hold a substantial market share in Germany, particularly in small and medium-sized enterprise financing, controlling around 70%, and overall general business financing, controlling around 42%, demonstrating their vital role in supporting the backbone of the German economy. Kreditstand für Wohnbau, or the Reconstruction Credit Institute, is Germany's state-owned development bank, established in 1948 to finance the post-war reconstruction. Today, it's one of the largest national promotional banks in the world. It does not take deposits from the public, but finances investments related to climate and the environmental protection, social development, innovation, and export promotion, both domestically and internationally. KfW's strong credit rating, AAA, allows it to borrow funds cheaply in capital markets and pass these low costs on to its clients, effectively subsidizing projects in the public interest. Brazil offers another compelling example in the form of the Brazilian Economic Development Bank, or the BNDES. Established on June 20th, 1952, as a government agency, its primary goal was and remains the development and implementation of national economic development policies. In 1971, it was converted into a state-owned company under private law, a change that provided greater flexibility in raising and investing funds while simultaneously reducing direct political interference. BNDES played a pivotal role in Brazil's import substitution policies during the 1970s, a strategic period that led to the development of Latin America's most complete and diversified industrial sector. This included initiating crucial investments in previously insignificant industrial segments, such as information technology and microelectronics, laying the groundwork for Brazil's technological advancement. In the 1980s, BNDES actively encouraged Brazilian companies to compete with imported products domestically and stimulated exports, helping Brazil gain a stronger foothold in global markets. The 1990s also saw BNDES emphasize regional decentralization through increased investment in less developed regions, aiming to reduce regional inequalities. Critically, it also began to incorporate environmental risk classification into its project assessments, becoming an early adopter of sustainable finance principles. Since 1995, the bank has brought broadened its mandate to include strong support for the cultural sector, investing in movie production and the preservation of Brazil's rich historical and artistic heritage, demonstrating a holistic approach to national development. Even in China, while its financial system is complex, the state owned Industrial and Commercial Bank of China, founded in 1984, stands as a massive testament to the scale of public banking. It's grown into the largest bank globally with assets exceeding $5.5 trillion. While operating within a unique framework, its state ownership means it plays a critical role in executing national economic policy and directing capital flows in alignment with strategic development goals, rather than purely private profit motives. These international examples underscore that public banking is not an anomaly, but a proven and often central component of diverse, successful economies, particularly those committed to long term equitable development. Understanding the potential impacts of public banks requires a thorough examination of their benefits and potential challenges. First, let's start with the benefits. Keeping public money Keeping public money invested locally. This is arguably the most fundamental benefits. Public banks ensure that the billions of dollars in public funds, for example from tax revenues, fees, pension funds, etc., collected by municipalities and states remain within the local economy. This means that banking profits and interest generated from these public funds circulate within the communities they serve, rather than being diverted to external interests or distant private shareholders. This mechanism directly supports the growth and prosperity of local businesses, fosters local employment, and counteracts the pervasive capital leakage from local economies that occur when public deposits are held by private banks whose profits leave the community. This creates a powerful multiplier effect, reinforcing local economic vitality. The second is significant cost savings for municipalities. One of the most compelling financial arguments for public banks is their ability to substantially lower borrowing costs for municipalities. When a city or state needs to fund a project, be it a new school, a water treatment plant, or road repair, it typically issues expensive bonds through private Wall Street banks. This process incurs substantial fees, underwriting costs, and high interest payments to private investors. By contrast, a municipality with its own public bank can borrow from itself, eliminating the need for these expensive bonds and significantly reducing the substantial interest payments that would otherwise flow to private banks. The resulting savings are immense, freeing up more revenue that can be redirected towards essential public services such as education, healthcare, affordable housing initiatives, and critical infrastructure improvements. The Bank of North Dakota serves as a compelling, century long example of this. By not paying interest to Wall Street, it consistently returns a substantial portion of its profits to the state's general fund, providing a non tax revenue stream that directly benefits North Dakotans. Next, leveraging lending power for the public good. Public banks are explicitly designed to leverage their lending power to directly benefit residents and address unmet community needs. Unlike private banks, which are primarily driven by market rates and risk adjusted returns, public banks can prioritize projects that align with public policy goals, even if those projects are less immediately profitable or carry higher perceived risks from a purely private sector perspective. This translates into affordable housing initiatives, providing low interest loans for construction or renovation of affordable housing, or direct financing to community land trusts. Small business loans, offering accessible capital to small and medium sized enterprises that struggle to secure loans from large private banks, especially those in underserved communities. Modernizing public infrastructure, financing everything from updated public transportation systems to climate resilient energy grids, water infrastructure, and public health facilities. The Bank of North Dakota's operational model, with its focus on commercial, agricultural, and student loans, serves as a prime illustration of the successful partnership approach, where capital is directed to sectors vital for the state's economy and social well being. The consistent focus of public banking proposals on these specific sectors demonstrates their potentials as tools for targeted capital allocation that serves public rather than solely private interests. Addressing banking deserts and countering predatory lending. Public banks can actively address banking deserts, which are areas predominantly in low-income and minority neighborhoods that lack sufficient access to mainstream affordable banking services. In such areas, residents are often forced to rely on predatory lenders, check cashing services, and payday loan providers that charge exorbitant fees and interest rates, trapping individuals in cycles of debt. By providing affordable banking services, low cost loans, and financial literacy programs, public banks can fill this critical void and counter predatory practices. Initiatives such as California's proposed Cal account exemplify this commitment, aiming to provide free, universal financial services to unbanked and underbanked Californians, a demographic that disproportionately includes black and brown individuals who have historically been underserved and exploited by the private financial system. Democratic oversight and community accountability. The emphasis on democratic oversight and community accountability highlights a governance model fundamentally distinct from that of private banking. Because public banks are owned by the government, they are subject to legislative oversight, public hearings, and ultimately the will of the voters. This creates a mechanism for finance to be more responsive to societal needs rather than being solely driven by market forces and shareholder demands. This represents a significant attempt to democratize finance, making it transparent, answerable to the people, and directly aligned with the long term vision and values of the community. While the benefits are compelling, it's crucial to acknowledge the potential drawbacks and challenges inherent in establishing and operating public banks. One of the first is that there's potential for bureaucratic inefficiencies. A significant criticism leveled against public banking is the potential for bureaucratic inefficiencies. Public institutions can sometimes be slower to adapt to market changes, less innovative, or less responsive to customer needs compared to their private counterparts due to rigid rules, civil service structures, and a potential lack of competitive pressure. Decision making processes might be slower, and there could be a perceived lack of agility in responding to dynamic financial landscapes. Mitigating this requires Mitigating this requires clear mandates, professional management, and a commitment to operational excellence, perhaps learning from successful models like Germany's Sparkassen or BND. Next is the risk of undue political interference. Another major concern is the potential for undue political interference in lending decisions. There is a risk that loans could be granted based on political connections or to fund pet projects favored by politicians rather than on sound financial principles or genuine community need. This could ultimately lead to a misallocation of resources, increased risk in the loan portfolio, and ultimately financial losses for the public. To counter this, robust governance structures are essential, including independent boards with financial expertise, clear statutory mandates, strong ethical guidelines, and mechanisms for transparency that protect lending decisions from partisan influence. The Bank of North Dakota's success in largely avoiding this pitfall over a century serves as a critical case study in effective governance. Third, the need for expertise and capitalization. Establishing a public bank requires significant financial capital to begin with and access to experienced banking professionals who understand the complexities of financial markets, risk management, and regulatory compliance. Without adequate capitalization and skilled leadership, a new public bank could struggle to compete or manage its portfolio effectively. Despite these challenges, the successes of existing public banks, from the Bank of North Dakota to the vast German Sparkassen networks and Brazil's BNDES, demonstrate that these institutions can be both financially robust and deeply committed to public service. They represent a viable and ethical alternative to our current financial paradigm, one that aligns with our Catholic call to economic justice and integral human development. In examining public and municipal banks, we find a powerful convergence of historical precedent, ethical imperative, and practical possibility. These institutions offer a compelling vision for a financial system that truly serves the common good, investing in the dignity of every person and the flourishing of our communities. It is a model rooted in accountability, justice, and solidarity, embodying the call of our faith to build an economy that works for all. Before we conclude, we would be grateful for your support in a few straightforward ways. If you enjoyed this episode of the Catholic Workers Podcast, please consider subscribing to our podcast on your preferred platform. This helps new listeners discover our content and ensures that you don't miss future episodes. If you have a moment, kindly leave us a rating and a thoughtful review. Your feedback is invaluable as it not only helps us improve, but also assists in expanding our reach within the podcasting community. Finally, we're a listener-supported podcast, and every contribution, no matter the size, helps us in continuing to produce these episodes. You can find us on Ko-fi, simply search for the Catholic Workers Podcast, or refer to the show notes for a direct link. Your generous support helps us cover our production costs and sustains this vital podcast. Thank you immensely for listening, and we invite you to join us next time as we continue to explore how our faith compels us to build a more just and equitable world, one conversation at a time. Until then, persist in the good fight.
Kyrie